Boom, bust, and then boom again. I'm Chris Hobart, the wealthologist, and this week we're going to be talking about one of the strangest economic roller coasters we've seen in a while, which says a lot. Let's talk about mirror image quarters, tariff myths, and what really matters for your money right now. All right, so let's rewind to Q1 of this year. The headline, it screamed recession. Real GDP shrank by 0.2%, and people were calling it a policy failure. Now, hold up. Industrial production in that same quarter, it jumped 4.5%, which is the best it's been since 2021. So, what in the world happened? Well, turns out the GDP drop was caused mostly from front running tariffs. Companies were, and consumers even, were importing a ton of goods before new taxes kicked in. Now, those imports don't count as domestic production in GDP math. So it pulled the numbers down. But the economy itself, well, still kicking. Now, here we are. Q2 GDP is rebounding big time. The Atlanta Fed projects 3.4% growth, and it could be even higher, possibly over 5%. Now, this is boomtown, right? Not exactly. Because this quarter is like the mirror image of the last one. Trade is swinging back the other way, which boosts GDP. But under the surface, industrial production is actually slowing, and retail sales, when they're adjusted for inflation, they're down 1.2% since December. And core GDP, which is consumer spending, business investment, and home building, it's growing at its slowest pace since 2022. So, no, this isn't a Trump boom. It's more like, I don't know, I guess we'd call it a tariff bounce, right? So here's the takeaway. These quarters really, they cancel each other out. On average, the economy is tracking at a growth trend, right? But with underlying weakness showing through. And that's not the only confusion that's going on out there. What about inflation? Now, the Fed, they're still fixated on year over year inflation data. But those numbers are being compared to already soft months from last year. So it's a bit misleading. If you want the real story, I'm going to encourage you to look at the 3-month and 6-month trends. They show slower inflation, which means monetary policy is still tight enough to keep the brakes on the economy. So the question that people are asking, why hasn't the Fed cut rates yet? Well, because Chairman Powell is still saying tariffs are inflationary. But guess what? There's actually not really good, solid evidence for that. Tariffs may raise prices on some goods, but they often pull money away from other spending, keeping overall inflation in check. We expect the Fed to hold out probably until September, but if this softness becomes more obvious, they're going to have to pivot. Something else to look at, what about Iran and the global tensions in oil? There's obviously concern that rising tensions could lead to oil price shocks, especially if Iran tries to restrict tariff in the Strait of Hormuz. Now, here's the thing. Even Iran and its allies need that passage to stay open. China wouldn't be thrilled with oil prices spiking. And if prices do jump, well, expect U.S. oil prices to ramp up fast. The thing is, the real risk, it's not oil. If the U.S. starts talking about boots on the ground in Iran at some point, that would not only be expensive, it could shift political focus away from things like the 2017 tax cuts and other economic stability. So what's the bottom line with all of these moving pieces and parts? This is kind of a weird moment. The numbers, they actually look great on paper. But if you begin to dive and look a little bit deeper, we are not in a boom. We're not in a bust. We're kind of somewhere in the middle and moving sideways. So what do we do as investors? Well, I know you're going to love to hear this, but the concept of staying diversified right now makes a lot of sense. Staying calm makes sense because the market hates uncertainty, so we can see some volatility at times. And I also want you to watch trends and not headlines. And ask yourself, if the economy stays flat, are your investments still positioned to grow? Let's talk about it. Head on over to our website or just message me directly. Happy to talk with you at any time. We're here to help clients find growth when the data doesn't make sense. And before you go, tell me in the comment section below, which number do you trust more, GDP or industrial production? I'll share my take in the next week's episode. All right, hit that like button, subscribe, and share this with someone you think that would appreciate some of this insight. As always, I'm Chris Hobart, the Wealthologist. We'll see you next week.